resume. Okay then. So today, good evening once again. Today we are going to be looking at cost of capital. As I explained to you earlier on, it's a very practical topic, and also it's fundamental to strategic financial management. So without wasting more time, what do you understand by cost of capital? What are the importance of cost of capital? What are the categories of cost of capital? Okay, how do you estimate cost of capital? All of these are what we are going to be discussing tonight. However, like I mentioned, it's a very big one. So wherever we stopped today, we are going to continue subsequently by the grace of God. Therefore, what is cost of capital? Simply put, cost of capital represents the compensation required by the providers of capital from their investments in a company. Okay, cost of capital represents the compensation required by the providers of capital from their investments in a company. Let me explain. When you say a company, it means the company must have owners. Okay, there are some people that put up their resources, their financial resources, to set up the operation of the company. The money that the owners have contributed to finance the operation of the company is not for free. The owners, which are shareholders, they are expecting a return on their investment, because the primary purpose of every business organization is to make profits. So if that is the case, the owners have contributed their capital with the expectation that when the business does well in the future, they will be able to earn return on their investment in form of a dividend. Therefore, the company will be paying dividend to the shareholders. So to the company that is paying it, it's a cash outflow, it's a cost. It's a cost to the company, but to the owners of the business, the shareholders, it's a return on their investment in form of dividend. So we are looking at the perspective of the company. Not only that, it is possible that a company might want to execute a project and the finance is not readily available. So they are going to approach investor or lenders that, oh, please, I need so much money. If the company is able to secure the loan or to secure the needed finance, then that loan is not for free. There are costs attached to the loan in form of interest expense, because once a company borrows money, that money you have borrowed, of course, you are going to pay interest on it. So because the company is paying it, that interest that the company is paying is a cash outflow. It's a cost to the company. Interest expense is a cost, is a cash outflow to the company, but to the debt holders or to the lender, so to them is a return on their investments. So when we now say cost of capital, we said that it is the compensation required. The shareholders require that compensation. The debt holders require the compensation. The preference shareholders require the compensation from their investment in a company. So cost of capital is the compensation required by the providers of capital or suppliers of capital or funds from their investment in a company. And it is determined, cost of capital is determined by the market forces of demand and supply, are consistent with the perceived risk associated with a company, which means that the higher the risk associated with a company, the higher the cost of capital that the company will pay, and vice versa. So it is expected that company will be able to generate sufficient returns that will be able to cover the cost in order to create value. The essence of every management of a company is to create value for the business in order to enhance the owner's equity value. So it is expected that management will be able to generate sufficient returns that will be sufficient, okay, to generate return that will be sufficient to cover the return, to cover the cost in order to create value. So this is the introduction to cost of capital. Now, let's talk about importance of cost of capital. There are 2 key importance of cost of capital. One, is project evaluation. Then 2, determining debt equity proportion. Let's talk about the first one. When you talk about cost of capital, the cost of capital is essential whenever a company wants to determine the financial viability of a project. In the determination of financial viability of a project, cost of capital will be needed to discount the future cash flow to its present value equivalent. Whenever you want to appraise a project, you are going to need cost of capital using relevant investment appraisal technique like the NPV, internal rate of return, modified internal rate of return, project duration, adjusted present value, and any other techniques. All right. So without the cost of capital, it will be difficult to discount the future cash flows to the present value equivalent. So one key importance of cost of capital is investment appraisal or project evaluation. You need it for project evaluation. Then 2, determining debt equity proportion. One of the objectives of a company or of a firm is to minimize the overall cost of capital of that company. So cost of capital will enable the company to determine the debt equity proportion to be carried in the capital structure. When you talk about capital structure, it's the way and manner a company finances its operation. Generally, long-term financing may be usually through ordinary share capital, preference share capital, and the debt capital. Each of them has its own underlying cost, and the objective is to minimize the overall cost of capital for the firm. So cost of capital will enable an organization to be able to determine what is the proportion of equity, what is the proportion of debt it should carry in the balance sheet, in the statement of financial position, in order to minimize the overall cost of capital. All right. So those are the 2 importance of cost of capital. So you can read this through the material. Then the next area we want to talk about is the categories of cost of capital. Let me see. Okay, I did not mention category. Let me explain it. All right, let me look for a space. Now, there are 3 categories of cost of capital. Let me break it down for you. Categories of cost of capital. 1 is traditional weighted average cost of capital. Traditional weighted average cost of capital. Then 2, project specific cost of capital or WACC. Then number 3, cost of capital, weighted average cost of capital, weighted average cost of capital of the combined activities. Okay, so these are the 3 categories of cost of capital. You have to be very careful. Whenever an examiner asks you to compute cost of capital, you must ensure that you know the cost of capital that you want to calculate, because it can come in any form. So I will take my time to explain each of them to you so that once you see it in a scenario, you will know the ideal cost of capital to compute. Now, one thing that is common to all the categories of cost of capital is that you are going to calculate weighted average cost of capital, and it is the same formula you are going to use to get your WACC, but the process of determining the WACC are different. The same formula you are going to use to compute your WACC, but the process of determining it are different. So let's take it one after the other. Now, when you talk about traditional weighted average cost of capital. The traditional WACC will be computed when information on the capital structure of a company is provided. I repeat, traditional weighted average cost of capital will be computed when information on the capital structure of a firm are provided. For example, you are given information on ordinary share capital, preference share capital, and debt capital. So it means that you are supposed to calculate weighted average cost of capital using traditional method. Okay. The second one, project specific, when a company is diversifying into a new industry, the existing work of the company will not be suitable to appraise the project in the new industry. Therefore, you need a cost of capital that is consistent with the systematic business and financial risk of the project. Okay? So that is only when you use project-specific cost of capital. The work of the combined activity, which are called WACOCA, is computed when a company is engaged in several activities at the same time. So instead of using different cost of capital to appraise each of the projects, so only one cost of capital that is suitable to appraise all the projects will be computed. So these are just the brief introduction on the categories of cost of capital. So we'll move into traditional weighted average cost of capital. Like I mentioned to you, please, I may not know. If I'm too fast, let me know so that I can call myself to order. Okay? So let's talk about traditional weighted average cost of capital. I've already explained to you that the traditional WACC would be computed when information on ordinary share capital, preference share capital, debt capital are provided in the question. So when you want to calculate, you can't just move in to calculate weighted average cost of capital. There are procedures you are supposed to follow. When you want to calculate traditional WACC, the first step that you are going to follow is to calculate the cost of capital of individual source of finance, or calculate cost of individual source of finance. For example, if in the capital structure of the company, you can see ordinary share capital, you can see preference share capital, you also have debt in form of bond, debenture, or loan notes in the balance sheet of the company, it means that you need to go and calculate cost of equity. If you see preference share capital, you are going to calculate cost of preference share. When you see debt in form of debenture, bond, or loan notes, that means you are going to calculate cost of debt. So that is what you need to do. The fourth step that you're going to carry out when you want to calculate your traditional WACC is to calculate the WACC itself using the appropriate formula, whether you want to use a book value method or you want to use market value method. All of these things, we are going to discuss it in details as we proceed or as we progress during the course of this class. Okay, then. So let's talk about, I mentioned to you, let me write it out. Okay, I have a space there. I mentioned to you that whenever you want to calculate traditional WACC, okay, whenever you want to calculate traditional WACC, there are 4 procedures you may likely carry out depending on the capital structure of the company. If in the capital structure, in the balance sheet of the company, you can see ordinary share capital, then in that case, you are going to calculate cost of equity. So calculate cost of equity. That's the first step. Step 2, if in the balance sheet of the firm, you can see preference share capital, it means that you are going to estimate, you calculate costs of preference share. Okay. Number 3, if in the balance sheets under the financed by, you can see any form of debt like bonds, debenture, or loan note, even bank loan, then you need to calculate cost of debt. So determine cost of debt. This is KD. This is KP. This is KE. Okay. Then the last step you are going to carry out whenever you want to compute traditional WACC is to calculate the WACC. Calculate the weighted average cost of capital. So these are the 4 procedures you are going to carry out whenever you want to compute traditional WACC. It is not compulsory that you are going to have all the 3 modes or source of long-term financing. It may well be there is only equity. If a company has only equity, it means that the company is only financed with equity, 100% ordinary share capital. It is possible that you may have only equity and debt, no preference share capital. So it is not compulsory that you have to have equity, preference share capital, and also debt capital. So it is whichever one you have in the balance sheet, those are the ones that you are going to compute for. So let's take it one by one. Today, we are going to be discussing in details the underlying principle of cost of equity. It's not just about calculate cost of equity. There are some underlying principles you must understand, which should be guiding you whenever you see a question, no matter how big is the question. Once you have the deep understanding of the concept or of the principle, you are good to go. So let's take it one by one. Remember, I told you earlier today, I mentioned to you that there are 3 I said cost of capital represent the compensation required by the providers of capital from their investment in a company. And I mentioned the providers of funds to you to include the ordinary share capital, the ordinary shareholders, the preference shareholders, and also the debt holders. So each of these 3, cost of equity, cost of preference share, cost of debt, these are the compensation that will be paid to those providers of capital. So we are starting with the cost of equity. So what do you understand by cost of equity? What do you understand by cost of equity? The cost of equity represents the minimum required rate of return expected by the ordinary shareholders from their investments in a company. I take it again. Cost of equity represents the minimum required rate of return expected by the ordinary shareholders from their investments in a company. It is also known as opportunity cost of capital. Cost of equity is also known as the opportunity cost of capital because the owners of the business would have invested their money elsewhere, but they decided to put the resources, the financial resources, in setting up the company. Therefore, the benefit that would have accrued to them in investing in other business opportunity, those benefits are being forgone. So that is why it is also called opportunity cost of capital. So what are the methods of estimating cost of capital? What are the methods of estimating cost of capital? Basically, there are 3 methods of determining cost of capital, including dividend valuation model. Okay? Dividend valuation model. 2, capital asset pricing model. 3, Miller and Modigliani formula. So for number 2, capital asset pricing model is a topic on its own. So under the cost of capital, we're not going to discuss capital asset pricing model because it's a topic on its own. When we get there, we are going to be discussing it. Again, the number 3, which is the Miller and Modigliani formula, we are not going to discuss it now until we get to adjusted present value. That is when we are going to need Miller and Modigliani methods of estimating cost of equity on geared. Okay, so the focus of this class will be on the dividend valuation model. Therefore, estimating cost of equity using dividend valuation model represents the relationship between dividend and the share price. cost of equity using dividend valuation model represents the relationship between dividend and the share price of a company's share. Okay, the share price or the price of a company's share. When you say share price simply means the price at which the company shares is being traded in the market or in the stock exchange. So that is share price. However, in the determination of cost of equity using dividend valuation model, there are two different ways in which cost of equity can be calculated. You can either calculate your cost of equity if in the question, dividend will remain constant to perpetuity. So where dividend will remain constant to perpetuity, then cost of equity will be the ratio of constant dividend to ex-div share price. Okay? Where dividend will remain constant to perpetuity, cost of equity will be computed as the ratio of dividend to ex-div share price. I like to use ex-div share price instead of just share price or market value. I like to use ex-div because when you use ex-div share price, it will call your attention to tell you that, okay, the denominator is supposed to be the share price that exclude dividend, because examiner can give you the share price that include dividend, which is what is called cum div. And you don't use cum div to compute cost of equity. Rather, it has to be ex div. That is the share price that exclude dividend. So I will be explaining to you what cum div is all about, what is ex div share price as we proceed. Okay, so what I'm trying to say in essence is that where dividend will remain constant, meaning that the same dividend that the investor will earn in the first year is what they are going to earn all throughout the life. Okay, for the foreseeable future, it will be the same amount. So in that case, since dividend will remain constant to perpetuity, therefore cost of equity will then be computed as the current dividend divided by ex-div share price multiplied by 100%. Let me remove all this to allow me to get space. Okay. So multiply by 100 over 1. So this is the formula that you are going to need to compute cost of equity, where dividend will remain constant to perpetuity. Okay? Yes. It is also possible examiner can ask you to calculate market value of equity where dividend is constant. In this case, market value of equity. Now, whenever you are asked to calculate market value of equity where dividend will remain constant to perpetuity, all you need to do is to just cross multiply the cost of equity. Just cross multiply the cost of equity. The denominator is the market value of equity per share. Okay, so in that case, market value of equity where dividend will remain constant is computed as current dividend divided by cost of equity. Okay, so this one will be in Naira. This one is in percentage, as you can see. This is in percentage. Okay, so whenever you're asked to calculate cost of equity where dividend will remain constant, this is the formula. When you're asked to calculate market value of equity where dividend will remain constant, this is the formula. Particularly when you get to business valuation, you are going to calculate market value of equity using this formula. All right, so that is that. The second areas is whenever you are asked, you may be told that dividend will grow. Okay, when there's growth in dividend payment, then you cannot use this formula. You have to introduce growth rate, because it is expected that the investor will expect that the dividend earned on a yearly basis increase relatively okay, increase relatively, so that you don't just the same due to prevailing market condition or economic condition. The same dividend you earned last year, you don't expect to earn the same thing this year because of, for example, inflation, the purchasing power of money. So the value of that dividend that you earned last year is not the same thing again this year. So it is expected that on a yearly basis, dividend will increase by a specific percentage. So that is the expectation of the shareholders or the investors. So whenever it is expected that whenever you want to calculate cost of equity, then you incorporate the growth rate. So it is possible examiner may not give to you the growth rate. You will be the one to estimate the growth rate. So how do you then determine the growth rate? So before we get there, let me give you the formula for calculating cost of equity where there is growth. So where there is growth in dividend payments, okay, where there is growth in dividend payments, so cost of equity will be computed as the current dividend, okay, current dividend, let me rewrite it. Current dividend, cost of equity is calculated as current dividend multiplied by 1 plus the growth rate divided by XDIV share price. XDIV share price plus the growth rate. All of this multiplied by 100 over 1. Okay? So that is the formula. Multiplied by 100%. Okay? Let me write that. Multiply by, sorry, my pen is not connecting. Okay, it's back. So multiply by 100 over 1. So this is the formula for calculating cost of equity where there is growth in dividend payment. So it is also possible, examiner may want you to calculate market value of equity when there is growth in dividend payment. So in this case, using this formula of cost of equity, so market value of equity will then be calculated as the current dividend multiplied by 1 plus the growth rate. In fact, this particular formula is what you are going to need mostly when you get to business valuation. Please watch out. So divided by cost of equity minus the growth rate. Like I said, whenever you want to calculate cost of a market value of equity, it's always in naira. That's why it is called value. Please watch out. Okay, so that is that. So these are the relevant formulas that you can use to calculate cost of equity. Okay, that's the formula to calculate cost of equity. So that is that. Now, you can see we have growth rates in this particular formula. How do you then, because in some instances, in fact, in most cases, examiner will not give to you the growth rates. It may well be that you are the one that will estimate the growth rate yourself. Therefore, how do you compute growth rate? Now, before we move to calculating growth rates, let's talk about XDIV share price and then the CUMDIV share price. It's not in this material. Let me explain it to you. What do you mean by XDIV share price and CUMDIV share price? It's a principle you must understand in calculating cost of equity. So let's start with XDIV share price. XDIV share price. What do you mean by XDIV share price? The XDIV share price is the share price that excludes dividend. The XDIV share price, let me write it down. This is the share price that excludes dividend. Okay. The ex-div share price is used. It is the ex-div share price that is used to compute cost of equity. Okay, it is ex-div share price that is used to compute cost of equity. Where cum-div share price is given, it should be converted to ex-div share price. Where cum-div share price is given, it should be converted to ex-div share price as follows. Okay, so ex-div share price is equal to cum-div share price minus current dividend. Okay, so that is the formula for calculating ex-div share price. And I also mentioned to you that ex-div share price is the share price that excludes dividend. Before you can calculate cost of equity, the dividend must have been paid to the shareholders. So if dividend has not been paid, that means the dividend is still outstanding or dividend is yet to be paid. That is the share price given in that instance or in that case represent the cum-div share price. Let me explain cum-div share price. Cum-div share price. This is the share price that include dividend. It is important. It is important or essential to note that the cum-div share price is not used to calculate, to estimate cost of equity. Okay? If cum-div share price is given, it must be converted to ex-div share price before calculating cost of equity. So whenever you are told in the question that, how do you know it's a cum-div share price? So whenever you are told in the question that the dividend is still outstanding, the dividend is yet to be paid, or the dividend will be paid, it means that the share price given to you is a cum-div share price. And like I said, cum-div share price cannot be used to compute cost of equity. It has to be ex-div share price. And I've shown you how to convert cum-div to ex-div share price. Okay, so that is another principle you must know as far as cost of equity is concerned. Now let's move to estimating growth rates. Again, please, if you have any question for me, let me know before I run away. So always raise your hand if you have any question for me, and I will explain to you in details whatever your question is. Okay, then. So in the cost of capital, cost of equity we have discussed so far, I mentioned to you that we have growth rates. If dividend will grow, okay, if there's growth in dividend payments, then it is important that you understand how to estimate growth rate, because on the day of your exam, examiner may not give to you. In fact, in most cases, growth rate will not be given to you. It is implied in the question. Examiner expected that you should be able to deduce what to do as far as the scenario paint for you is concerned. Therefore, how do you then estimate growth rate? I explained to you the other time that ordinarily, the investors or shareholder will expect that their annual dividend will grow relatively. All right. So no investor will want to receive the same return over the years. Okay. So it is expected that the returns will increase, okay, on a yearly basis in order to account for price level changes and other external variables that may impair the value of the money or of the returns. Okay, so how do you then compute growth rates? There are two methods of estimating growth rates. One is historical patterns of dividend payments. Then two, Gordon growth model. For the historical pattern of dividend payment, is also known as averaging method. Okay, historical patterns of dividend payments is also known as averaging method. This method is used when the history of dividend payment is given year on year. I will explain to you. I said the historical pattern of dividend payments is used to compute growth rates when the history of dividend payment is given year on year. Now, let me explain that in details. When you talk about historical pattern of dividend payments, which are also called averaging method, historical, let me write that. So, as far as historical patterns of dividend payment is concerned, I mentioned to you that when the history of dividend payment is given year on year, that is when you use historical pattern of dividend payment or averaging method. There are two different formulas that you can use under historical pattern, depending on the history of the dividend payment. The first one, when the history of dividend payment is given year on year. Number A, when the history of dividend payments is given year on year, then in that case, growth rate will be computed as n minus 1 into square root latest dividend divided by base year dividend, all minus 1. Okay? Now, this formula you are seeing here will only be used if the history of dividend payment is given year on year. For example, let me show you what I mean by that. For example, you are given history of dividend payment in this form: year, then dividend paid. Year 1, year 2, year 3, year 4. Say dividend paid in the first year is 2 naira. In the second year is 3 naira. In the third year is 5 naira. And then in the fourth year is 6 naira. You can see that the dividend paid for each respective year is provided, and the dividend has increased from 2 naira in the first year to 6 naira in the fourth year, in the current year. That means dividend has grown. So when you are given information in this format, you are given the history of dividend payment in this format, then The formula above is expected to be used to calculate the growth rate. So in this case, if I want to calculate growth rate, I will just say G equal to, I will go back to the question given to me. How many years, what is the value of N? N is equal to 4 because we are given 4 years, year 1 to 4. So N is 4. I will say 4 minus 1 into square root. LD is the latest dividend or current dividend. The current year is 4. Year 4 is the current year. Therefore, current dividend is 6 naira divided by BD is the base year dividend. That is dividend paid in the first year. So dividend paid in the first year in this, our hypothetical figure is 2 naira. All minus 1. Okay? Therefore, I can then say G is equal to 6 divided by 2 is 3. So I can say G equal to 3 mathematically raised to power 4 minus 1 is 3. So raised to power 1 over 3 or minus 1. Whatever I have, I will get my growth rate. So in this case, if I want to solve this, I will just bring out my calculator to say 1 divided by 3 using your casual calculator is 0.333 whatever. Okay? So I can then say 3 raised to power 0.333 whatever. So I get that, then minus 1. Whatever answer I have on my calculator, I will minus 1. So I will get the value for my G, for my growth rate. I will get the value of my growth rate. So this is how to calculate. This is how to calculate growth rate, where history of dividend payment is given year on year. And I believe this is clear. Please, I've already encouraged you. If you have any question, please always raise your hand. Let me know on time. All right. So the second one, the second formula that you can use when the history of dividend payment is given or when the historical patterns of dividend payment are provided, then the second one is given as G, number B, where the history or where the information of the first year dividend and the current year dividend are given. So in this particular instance, examiner will not give to you the information of dividend paid across all the relevant years. Only the first year dividend paid and the current year dividend paid will be given to you. So in this case, growth rate will then be calculated as N into square root dividend, the current year dividend divided by dividend paid in the first year, all minus 1. You will notice that both the first formula and the second formula, they look alike, but they are slightly different. Okay, they are different because the first one has N minus 1. The second one does not have minus 1. Okay, the first formula has minus 1, but the second formula does not have minus 1. So watch out. So now I mentioned to you, this second formula will be used where the information of the first year dividend and the current year dividend are given. For example, all these little things, they can't, because when you see a bigger question, you must, once your understanding of these little principles will enable you to interpret the question appropriately. So, for example, examiner can tell you that the dividend paid, the dividend paid 5 years ago is 5 naira. Why the current year? Why the current dividend is 8 naira? You can see examiner has given to us the information on the dividend paid 5 years ago and the current year dividend. So in this case, all I need to do is to interpolate, put the figures in the formula, and I'm good to go. So for this purpose now, if I want to calculate my growth rates, let me manage the space here. If I want to calculate the growth rate, I would just say G is equal to N. In this case, what will be our N? Examiner has told us that 5 years ago, that means N is equal to 5. N is equal to 5. Here I would then say 5. I can change my formula. It's the same thing. I can change my formula to say LD divided by BD raised to power 1 over N minus 1. It's the same thing. I've converted that other formula to this. 1 over N. Okay, so it's the same thing. So in this case, I can then say G is equal to, my latest dividend is 8 naira. So 8 divided by dividend paid in the first year is 5 naira. So 5 years ago, raised to power 1 over 5, or minus 1. So I will get my answer. It's as simple as that. Please watch out. Watch out. So this is your starting point. All this principle we are discussing is your starting point. You must understand it so that when you see a bigger question, bigger scenario, you are not going to be distracted. You are not going to be thrown off balance. All right. So it is important that you have deep understanding of all these underlying principles. Okay. So that is that. Now, in the estimation of growth rate, we have already talked about the historical pattern of dividend payment. So let's talk about Gordon growth. How do you calculate growth rates using Gordon growth? The Gordon growth model will be used to calculate growth rates when information on earnings and capital employed are given. I repeat, Gordon growth model can be used to compute growth rates when information on earnings and capital employed are given. So watch out. So if that is the case, when you want to calculate growth rate, let me look for space. When you want to calculate growth rates using Gordon growth, G will be computed as return on capital employed multiplied by retention rates. R is the return on investment or return on capital employed. B is the retention rate. So you need to first of all go ahead and compute the return on capital employed. You also compute retention rate before you can calculate your growth rate. So if I want to calculate the return on capital employed, I would then say return on capital employed is equal to earnings divided by capital employed. Okay. Multiplied by 100 over 1. You know, one of the limitations of primary ratio is the definition of capital employed. Capital employed can be defined in several ways. It could be total assets. It could be net assets. It could be equity plus debt. It could be anything. The information in the question will tell you if capital employed is not given to you directly. The information given in the question will tell you which one to use, whether you should use total assets, net assets, or capital or equity plus debt. All right. Whichever one you use, you should be able to state your assumption. So when you talk about earnings, earning is the same thing as profit after tax. In the income statement, you know, the primary, the top line in the income statement is the revenue. So the bottom line is what we are talking. The bottom line is the net profit. That net profit is the earnings. Okay. So This earnings should be earnings attributable to the owners of the business, not earning before preference dividend. It has to be the earnings after preference dividend. So if preference dividend is given in the question, then you must deduct preference dividend from the profit after tax to have the earnings attributable or profit attributable to the owners of the business. But again, yeah, that is for that. Then it is also possible in the question, you may not be given capital employed. Where capital employed is not given, then return on capital employed, it can be calculated as earnings divided by opening shareholders fund, opening shareholders fund multiplied by 100 over 1. Okay, that is that. Then the second part, which is retention. Retention rate, denoted as B, can be calculated as earnings. That space is small. Let me use it. Retention rate is computed as earnings minus dividend divided by earnings multiplied by 100 over 1. So this particular formula will be used if you are given earnings in the question in absolute number. If earnings are given in absolute figure, then in that case, use this formula. But in some instances, it is possible that the earnings may be given to you, any per share may be given to you. So if any per share is given to you, then in that case, you can say retention is equal to any per share minus dividend per share divided by earnings per share, or multiplied by 100 over 1. Okay, or multiplied by 100 over 1. So watch out for that. So these are the relevant formulas that you can use to compute growth rates. So that is that. At this point, so far so good. I've explained to you all the underlying concepts, all the underlying principle of cost of equity. It is no more than this. So you have responsibility to be able to digest it, and so that when you see a bigger question, you'll be able to do it appropriately. You'll be able to solve it accordingly. So that is as per cost of equity. Let me see if I can have a short illustration to demonstrate what we have discussed so far. Let's see. So please let me know if you have any question for me. So always come up when you have any question. You are free to ask me any. Okay? Yes. Let's solve illustration number 1. I need one of you to read for us. Who will help us to read? Yeah? Who is helping us? Somebody should help us to read. Otherwise, I will call one of you now. Okay. Yes, Wellington, please read. Wellington.
Good evening, sir. Good evening.
Good evening. Thank you.
OZ PLC is a company with 5 million ordinary share of ₦1 each, currently quoted at ₦1.40 as at 31st December 2012. The company's current dividend of 30 kobo is about to be paid. The historical trend of the company's dividend is given below. Year 2007, dividend 15 kobo, 2008, 18 kobo, 2009, 20 kobo, 2010, 24 kobo, 2011, 27 kobo, 2012, 30 kobo. You are required to calculate the company's cost of equity capital.
Thank you very much, Wellington. Yes, that is the question. That is the question. So please pay attention. Whenever you are given a question and you are asked to calculate cost of capital or cost of equity capital, like in this case, you have to shine your eye. You don't just rush and be solving questions just simply because of you must understand the requirement. So in this question, you are asked to calculate cost of equity capital. So you need to ask yourself, what kind of cost of equity? Because I told you, there are three different methods that you can use to estimate cost of equity capital. You can use dividend valuation model. You can use capital asset pricing model. You can use Miller and Modigliani formula to compute cost of equity. And I mentioned to you, dividend valuation model will be used when information on dividend and share price are given. So in this question, you can see information of dividend. Examiner has given to us the current dividend to be 30 kobo. Even the history of dividend payment are given to us. Share price is given to us as 1 naira 40 kobo. So that means we are going to use dividend valuation model. I repeat, dividend valuation model will be used to compute the cost of equity for this question because the history of dividend, information on dividend and the share price are given. I believe that is clear. So if that is the case, I want to calculate cost of equity capital for OZ PLC. So let me switch. Let me see if I can get instead of switching to working notes. No, let's switch to the working notes. Let me switch to the working notes so that I will have a freedom to play around. So let me stop sharing this place. Let me know if you can see my screen, please. Can you? Can you see my screen?
Yes, sir, we can see it.
All right, then. Thank you. Okay. The name of the company is OZ. Illustration 1. Okay, OZ PLC. Examiner is asking us to calculate cost of equity capital. I would then say calculating cost of equity capital, denoted as K. Please, on the day of your exam, don't go and be writing cost of COE, Center of Excellence. Don't go and be writing COE. You have to write it out in full, at least in the first instance. You are going to be penalized if you don't break down, if you don't write it out in full first, because you don't want examiner to be racking his or her brain on what you mean by COE. All right, COE can mean anything. Okay, then. So in this case, I would then say cost of equity equal to, before I put down my formula, I must understand the kind of cost of equity that I want to calculate. So because the history of dividend payment is given in the question, that means I'm supposed to calculate cost of equity using dividend valuation model. And I also mentioned to you that using dividend valuation model, there are different ways you can calculate your cost of equity depending on whether dividend will remain constant to perpetuity or dividend will grow. So in this question, examiner has given us dividend paid from 2007 to 2012, and you can see that dividend has increased from 15 kobo to 30 kobo between 2007 and 2012. That means dividend has increased, dividend has grown. So if dividend has grown, you can see growth rate is not given to us in this question. So it is implied that you are going to first of all calculate the growth rate before you compute the cost of equity. So let's go ahead. First thing first, we need to calculate the growth rate. So, but since we have identified from the question that the dividend will grow, I will then come here, I will say current dividend denoted as DO multiplied by 1 plus the growth rate divided by XDIV, X dividend share price, plus the growth rate. All of these guys multiply by 100 over 1. So this is the formula that we're going to use to compute the cost of equity. So in this question, G, which is the growth rate, is not given to us. So we are going to estimate the growth rate. So let's go and do our workings. Let's use this place as our workings. Working number 1, calculating growth rate. G. So I need to ask myself, how am I going to calculate my growth rate? You see the way I'm picking it? I cannot proceed from this formula because I know that I will need growth rate. You must know what to do at the right time. So I know that I'm going to need growth rate. So I need to go and calculate growth rate first. Once I compute the growth rate, I also need to check from the question whether dividend has been paid or not. If the dividend has not been paid, then I need to go and calculate SDF share price. Watch out. So I want to calculate growth rate. So I need to ask myself, how am I going to calculate my growth rate? Am I going to use dividend value? Am I going to use historical pattern of dividend payment, or I'm going to use Gordon growth? You can see in the question, the history of dividend paid between 2007 and 2012 has been given to us. So what that means is that we are going to calculate growth rate using averaging method, that is historical patterns of dividend payment. Okay, I will then come here. Growth rate will be computed. Remember, under the historical pattern of dividend payment, I give you two different formulas. But in this particular question, the history of dividend paid for the respective years were given. So in that case, I would then say n minus 1 into square root. Let me write that. Into square root, current year dividend divided by dividend paid in the first year, or minus 1. So which is equal to, my G will then be equal to n between 2007 and 2012. How many years do we have there? Talk to me. I need you to participate, please.
6 years.
6 years between 2007 and then 2012. That's 6 years. So n is equal to 6 minus 1. 1 is constant, divided by, what's wrong with you? Why are you joking? It's me. Shut up. Be careful. Let me write it again. Okay. Now, LD is the latest dividend. According to the question, latest dividend is the current year dividend. The current year is 2012. So dividend in 2012 is 30 kobo. So here I will put 30 divided by BD is the base year dividend or dividend paid in the first year. According to the question, dividend paid in the first year is 15 kobo, or minus 1. Therefore, G is equal to 6 minus 1 is 5 into 30 divided by 15, that's 2, or minus 1, equal, okay? Mathematically, I can say 2 raised to power 1 over 5 or minus 1. So give me the final answer. What do you have there? G is equal to what? Bring out your calculator and give me the number. To do this, you will say 1 divided by 5 equal, you are using a Casio or Popo. So 1 divided by 5 equal, which is 0.2. You leave it in your calculator. Just press 2. 2 raised to power answer on your calculator equal minus 1 equal multiply by 100% equal. That's 14.89%. Here is 14.89%. Approximately, the growth rate is approximately 15%. Please let me know if you understand what we have done so far before I run beyond your catch. Talk to me. Do you understand how I got the growth rates? Please, I need you to speak up. You guys are very quiet. That will not work in my class. You have to participate. Anyway, I believe you understand what we have done so far. Move on from here. So we have calculated G. I will then come here. KE equal to the current year dividend is 30 kobo into 1 plus 15% will give us 1.15 divided by, before I put down I have XDIV share price. I need to go back to the question to go and find out the share price given to me, whether dividend has been paid or not. Examiner told us in the question, in the first paragraph, that the company's current dividend of 30 kobo is about to be paid. The company's current dividend of 30 kobo is about to be paid, which means that the quoted market price of the company's share of that 1 naira 40 kobo included dividend of 30 kobo. So you cannot use the 1 naira 40 kobo share price to compute cost of equity because it is cum div. Remember, I told you cum div share price means that the share price that include dividend. You don't use the share price that include dividend to compute cost of equity. It has to be the share price that exclude dividend. Therefore, if cum div is given to you, you must first convert it to XDIV share price before computing the cost of equity. Therefore, let's go and do that. So I will then go to working number 2. Working number 2, XDIV. I want to calculate XDIV share price. And I told you XDIV share price is computed as cum div share price minus current dividend. So the XDIV share price is 1 naira 40 kobo. Current dividend is 30 kobo, 0.30. Therefore, XDIV share price is 1 naira 10 kobo. That's it. You see the way we are making adjustments? So this is what is expected of you. You can't just go around be solving question anyhow. You must understand what you are doing. So I need to go back there. So my denominator is 1.10 plus the growth rate of 0.15. All of this multiplied by 100 over 1. So finally, my cost of equity will then be equal to, mathematically, bring out your calculator. So from your calculator, you say 30 multiplied by 1.15 equal divided by, okay, so this is 0. Hold on first. It's supposed to be 0. Since we are using naira, it's supposed to be 0.3. 0.30. So we are using naira, not kobo. So let's do it again. 0.3 multiplied by 1.15 equal divided by 1.10. equal plus 0.15 equal multiply by 100% equal, that's 46.36. That's random. That's 46%, approximately 46%. So the cost of equity of OZPSC is approximately 46%. So I can say, let me use this space. The cost of equity of OZ PLC is approximately 46%. Okay, that's end of the question. That's end of the question. Let me know if you have any question before we move to the next one. I will stop sharing this. Let's have one more example under cost of equity. Okay. Let me see if I can have one more illustration on this. Okay. When we want to solve a bigger question, okay, we're going to look into that. But for now, let's move on to cost of preference share. Let's move on to cost of preference share. Okay. Cost of preference share. I want us to be talking on the same page. That's why ordinarily, yeah. Let's talk about cost of preference share. When you talk about preference share is a kind of hybrid capital. It has the element of equity and element of debt. That's why it is called hybrid. Okay, hybrid capital. Now, when a company finances operation with preference share capital, it is expected that the company will pay the preference shareholders a compensation from their investment in the company in form of a preference dividend. So when a company finances with preference shares, the preference shareholders must be settled before the ordinary shareholders, but after the debt holders will have been settled from the performance of the company. Now, there are different types of preference share. We have redeemable preference share. We also have irredeemable preference shares. We have cumulative preference share, non-cumulative preference share. We have participating or non-participating preference share. However, the one that involves calculation is the redeemable or irredeemable preference share. Every other ones are purely theoretical. When you talk about cumulative preference share, what it simply means is that when a company ordinarily, from the profits before tax of the company, from the profit after tax of a company, immediately after the profit after tax, we are supposed to pay preference dividend. Now, if in a particular year, a company incurs losses, when you incur loss, there is no way you'll be able to pay the preference dividend. So you have to defer into the future until the company until the company generates profit that will be sufficient to pay the preference dividend. So when it comes to cumulative preference share, so if a company makes loss, makes loss in a particular year, that preference dividend that the company is supposed to pay will not be, because of course you don't have profits to pay that, so you have to defer into the future. So you'll be accumulating it. If in the second year the company still make loss, okay, you cannot pay preference dividend. You add it to the preference dividend you're supposed to pay in the first year. So you continue to accumulate it until the company can make sufficient profit to settle or to offload the outstanding preference dividend. So it is called cumulative preference share because the dividend, the preference dividend, will be accumulating year on year until the company is able to pay it. But if it is non-cumulative, it means that you cannot defer in a year that the company does not make profits. In a year the company make loss, so you are going to forgo the preference dividend. You won't pay anything. So that is because it is non-cumulative. All right. So again, it's purely theoretical. So we don't have any calculation. So let's focus on redeemable and irredeemable preference share. Now we are going to start with irredeemable preference share. When preference share is irredeemable, what this simply means is that the company will pay annual fixed dividend to perpetuity, but the principal will never be repaid. All right, I repeat, when preference share is irredeemable, it means that the company will be paying annual fixed dividend, but the principal will never be repaid. So in this case, how do you then calculate when preference dividend is irredeemable? How do you calculate the cost of preference share? Or how do you calculate the cost of irredeemable preference share? The cost of irredeemable preference share is computed as the ratio of fixed dividend to ex-div share price. I repeat, the cost of irredeemable preference share is computed as the ratio of fixed dividend to ex-div share price. Let me show you. So cost of irredeemable preference share is computed as the ratio of fixed dividend to ex-div share price multiplied by 100%. Okay, ex-div share price multiplied by 100%. So that is the formula. That is the formula for calculating the cost of irredeemable preference share. The same principle that you need to convert cum div to ex-div share price also apply under the preference share. Okay, so let's find a simple illustration to demonstrate this. Yes, let's have illustration number 2. I need one of you to read illustration number 2. Somebody should read illustration number 2.
Adenine PLC has an issue preference share with the nominal value of 25 kobo. The agreed dividend of 5 kobo has just been paid. Required, what is the cost of preference share?
Okay, that is it. Very clear. Examiner is asking you, what is the cost of a preference share? You don't just rush to answer question. You must understand the requirements. Examiner is asking you, what is the cost of a preference share? Examiner did not tell you to calculate cost of irredeemable preference share. You are not asked to calculate cost of redeemable preference share. So it is implied in the question that you know what to do at the right time. So it will be irredeemable preference share if and only if the redemption date is not given in the question. You can see there is nowhere in the question that it is mentioned that it is irredeemable preference share. Adenine PLC has an issue preference share with a nominal value of that. The agreed dividend of 5 has just been paid. So you are not told whether it is redeemable or irredeemable preference share. The only thing that differentiates redeemable and irredeemable is if in the question, if you are given the redemption date, that is when the principal sum will be paid, then it is redeemable. Other than that, it will be irredeemable preference share. So like in this case, it is irredeemable preference share because we don't have the redemption dates. So if that is the case, how do you compute the cost of irredeemable preference share? I don't need to switch to the working notes. I can simply say cost of, the name of this company is Adenine. Okay, I hope this place will be sufficient for me. So Adenine PLC, then calculating costs of preference share, KP. So it is irredeemable. Therefore, I will say KP equal to fixed dividend. There is no growth in preference dividend. Preference dividend is always fixed. So divided by XDIV, share price, multiplied by 100 over 1. So KP equal to, I will then go to the question, what is the dividend? We are told that the agreed dividend of 5 kobo has just been paid. It means that it is XDIV share price. That 25, you can see, examiner has given us nominal value instead of share price. We are given nominal value. It is whatever you are given is what you are going to use. Therefore, I would then say fixed dividend is 5 kobo. 5 divided by XDIV share price. We are using the nominal value, which is 25 kobo. 5 divided by 25 kobo multiplied by 100 over 1. So what do you get? Bring out your calculator. Bring out your calculator. What do you get? What's the answer? I need you to participate.
20%.
20%. Thank you. So this is 20%. Therefore, the cost of the irredeemable preference share of Adenine PLC is 20%. That's all. That's all. Okay? So let's move on. Let's move on. Let's talk about redeemable preference share. Let's talk about redeemable preference share. A redeemable preference share is the one in which the company will pay both the annual fixed dividend and the principal at the redemption dates. Okay? I repeat, the cost of redeemable preference share is the one in which the company will pay both the the fixed dividend and the principal at the redemption dates. Okay, so whenever you want to calculate cost of redeemable preference share, it simply means calculating internal rate of return. Cost of redeemable preference share is the same thing as internal rate of return. And when you want to compute the cost of redeemable preference share, there are 3 stages. 1, you need to assume 2 discount rates that will produce 2 opposing NPV. One discount rate will give positive NPV, then another discount rate will give you a negative NPV. Then step 2, you proceed to calculating internal rate of return, which is the same thing as cost of redeemable preference share, using the internal rate of return formula, this formula here. Okay? Majorly, those are the two steps that are expected to carry out. Okay? Now, every other principle still apply. Cum div, ex div share price still apply. However, one important thing you need to take into consideration is that the preference dividend will be redeemable if and only if the redemption date is given. So if you are not given the redemption date is the maturity date, is the date in which the principal amount will be repaid to the investor. You know, the company has borrowed money, or the company has the investors, or the preference shareholder has invested in the company, say for example, for the next 5 years. So the next 5 years is the redemption date. So, but if you are not given the redemption date, you are going to calculate as cost of irredeemable preference share. But once you are given the redemption date, then it is redeemable preference share. The same thing applies to the cost of debt. But when we get there, we'll explain again. Okay. Yes. Let's have an illustration, a short illustration to demonstrate it. Let's have a short illustration on the cost of redeemable preference share. Yes, let's have this illustration number 3. Illustration number 3. Who will be helping us to read, please? Yep. Illustration number 3. Who will help us to read?
Johnson PLC.
Thank you, Wellington.
Yes, Johnson PLC is financed with 1 million redeemable preference shares with a nominal value of 1 naira and nominal rate of 8%, but currently quoted at 1 naira 5 kobo SDV. The preference share will be redeemed at bar in 5 years' time. Required. Calculate the cost of preference share.
Thank you very much, Wellington. Now, one more thing I need to call your attention to is the fact that when you talk about redeemable preference share or redeemable debt, preference share can be redeemed at par, at a premium, or at a discount. Usually, preference share is quoted at a nominal value of 1 naira. That's the par value. Okay, the par value of a preference share is usually at 1 naira. So if the preference share is quoted at a discount, it means that it will be lower than 1 naira. If the preference share is quoted at a premium, it means it will be more than 1 naira nominal value. Please watch out. I've said that preference share can be quoted at par, at a premium, or at a discount. If it's at par, it means it's at a nominal value of 1 naira. If it's at a premium, it means it is higher than 1 naira. If it's at a discount, it means it is lower than 1 naira. So watch out for that. In solving this particular question, let me switch to the working notes because I need space. Okay. The name of the company is Johnson PLC. So Johnson illustration 3. Johnson PLC. Examiner is asking us to calculate cost of preference share. You can see examiner did not tell you to calculate cost of redeemable or irredeemable preference share because it is implied in a question. I mentioned to you when we had the first illustration under preference share, I mentioned that the only thing that differentiates between redeemable and irredeemable preference share is the redemption date. If in the question you are given the redemption date, it means you are supposed to calculate cost of redeemable preference share. But if you are not given the redemption date, it will be cost of irredeemable preference share. So in this question, examiner has told you that the preference share will be redeemed at par in 5 years' time. 5 years' time is the redemption date. 5 years' time is the redemption date. Therefore, I need to calculate internal rate of return. So, to get the internal rate of return, I will then come here. I will say calculating costs of redeemable preference share. Okay? Remember what I told you. There are two procedures. The first procedure is to assume two discount rates that will produce two opposing NPV. Then the second procedure is to proceed to calculating cost of redeemable preference share, which is internal rate of return. That's all. That's all you need to do. Therefore, I will say assume whenever you want to calculate internal rate of return, especially under cost of capital, always start with 10% discount rates. So that if 10% produces negative NPV, you can reduce to 5%. If 10% produces a positive NPV, you can increase to 15%. Okay? So assume 10%. I will teach you exam technique such that we are going to, instead of drawing two different tables, we are going to use only one table. That will be faster. So in this case, I will create a column. I want to calculate NPV. Therefore, I will create a columns for year, description of items if necessary, create a column for cash flow, create a column for discount factor at two different discount rates, then you create a column for present value. Okay, so first thing first, we want to assume 10%. The useful life, the maturity date of this preference share, we are told is 5 years. Therefore, it means that the company will pay annual fixed dividend from year 1 to 5. Then from the final year, the year 5, the preference share will be redeemed at par. Therefore, I'm going to have year 1 to 5, then the 5th year. Before that, I need to, for year 0, year 1 to 5, then year 5. In year 0, you are going to have the current market value, the market value of the preference share. I will then go back to the question, what is the market value of the preference share? Examiner has told us that the preference share is currently quoted at 1 naira 5 kobo ex dividend. That is, that 1 naira 5 kobo already excluded dividend. So that means we don't need to make any adjustments. So two things I can do. I can either use par value for my calculation, or I use absolute value for my calculation. Whichever one I use, I'm going to get the same answer. Okay. If I want to use absolute value, okay, let me go and do my working somewhere. If I want to use absolute value, let's say my working will start from here. Working number 1. I want to calculate current market value. To get my current market value, it will be the number of shares multiplied by xdiv share price. Number of shares according to the question We are told that Johnson PLC is financed with 1 million redeemable preference shares. Number of shares is 1 million. So market price, ex-div share price is 1 naira 5 kobo. So here is 1 million shares multiplied by 1 naira 5 kobo, which is equal to 1,050,000. That's the current market value. Then 2, I need to calculate working number 2. I need to calculate fixed dividend. According to the question, okay, according to the question, the dividend, annual dividend, we are told that the nominal rate of 8% is the amount payable as dividend. So if the dividend is 8%, that is 8% of 1 naira. So using the absolute value, then my fixed dividend will be calculated as the nominal, the number of shares multiplied by nominal rates multiplied by nominal value multiplied by nominal value multiplied by nominal rates. This will give me the total dividend paid, total preference dividend paid. So number of share is 1 million. Nominal value is 1 naira. Nominal rate is 8%. This will give us 80,000 naira. So annual fixed dividend is 80,000 naira. I hope you are following. The next thing we need to do, of course, we already know the redemption to be, we want to calculate the redemption value. So since it will be redeemed at par, working number 3, redemption value, it will be redeemed at par. So which is number of shares multiplied by nominal value equal to 1 million shares multiplied by 1 naira equal to 1 million naira. So that is for that. Now, at this point, I can then proceed for my calculation. So the current market value is 1,050,000 naira. You put it in bracket for year 0. My fixed dividend, is 80,000 naira per annum. Because dividend has been paid, that's why we are using 80. If dividend has not been paid, you need to first of all go and calculate the ex-div share price. But that 1 naira 5 kobo given to us is already ex-div. So in the final year, which is year 5, we are going to calculate redemption value. We are told that the preference share will be redeemed at par. At par means at the nominal value of 1 million naira. Therefore, at 10%, cost of capital for year 0 is 1. At 10%, cost of capital annuity factor of year 1 to 5, because the fixed dividend of 80,000 naira will be constant. Year 1, 80,000. Year 2, 80,000. Year 3, 80,000. Up to year 5 is 80,000. So instead of you to be doing it one by one, it's better for you to just calculate annuity factor and move on from there. Therefore, calculating annuity factor at 10%, year 1 to 5. So I will say 1.1 raised to power 5 minus equal minus 1 equal divided by 0.1 equal. That's 3.791. Here is 3.791. If you don't know how to calculate annuity factor, let me just show you. but it's expected that you know it. Number 4, annuity factor, AF. Annuity factor is calculated as 1 minus 1 plus R raised to power minus N, all divided by R, equal, according to the question, we are assuming 10% discount rate. Therefore, 1 minus 1 plus 10% will give us 1.10 raised to power N is equal to 5 years. So minus 5 divided by R of 10%, 0.10. This gives us 3.791. So use your calculator and confirm the number. That's it. Okay. Discount factor at 10% for year 5 will be 0.621. Let me confirm that. 1.1 raised to power 5 minus equal. Yeah, that's it. So that's that. So let's multiply now. I would then say 1050,000 multiplied by 1 will give us 1050. Here at 10%, here is 1050. Then 80,000 multiplied by 3.791. 3.791. Sorry. 791 equal, oh, error. 80,000 multiplied by 3.791 equal, that's 303,280. 303,280. Then here will be 621,000. So let's find our MPV. What's our MPV? 621, 303,280 plus 621,000 equal minus 1,050,000 equal 125,720. Here is 125,720 negative. So we assume 10% and we got a negative MPV. So let's assume a lower discount rate to get a positive MPV. So let's assume 5%. So let me rule my table first. Okay. So 5%. So let's calculate annuity factor of year 1 to 5 at 5%. Using the first example I did, so I'll just say 1.05 raised to power 5 minus equal minus 1 equal divided by 0.05 equal, that's 4.329. Here is 4.329. So 4.329 multiplied by 80,000 naira equal 346,320. 346,320. Then, of course, here is 1 million and 50,000 at 5%. I hope I'm not talking to myself alone. Are you guys following me?
Yes,
Are we
sir.
still together?
Yes, sir. Yes, sir.
Okay. All right then. So let's calculate discount factor for year 5 at 5%. 1.05 raised to power 5 minus equal 0.784. Here is 0.784. Multiply by 1 million will give us 784,000. Okay. Therefore, let's get the MPV at 5%. So 784,000 plus 346, 320 equal minus 1,050,000 equal. That's 80,320. Here is 80,320. So we assume 10%. We got a negative MPV of 125,720. We then reduced to 5% discount rate. We got a positive MPV of 80,320. Now that we have two opposing MPV, we can then proceed to calculating the internal rate of return, which is cost of redeemable preference share. I would then say KP, cost of redeemable preference share, which is the same thing as internal rate of return, is computed as lower discount rates plus net present value of the lower discount rates divided by net present value of the lower discount rates plus net present value of the higher discount rates. All of this multiplied by higher discount rate minus lower discount rates. So cost of redeemable preference share will then be equal to, we assume 5 and 10% discount rates. 5% is lower. I would then say 5 plus MPV of that 5% is 80,320 divided by 80,320 plus MPV of the higher discount rate of 125,720. Okay. All of this multiplied by higher discount rate of 10 minus lower discount rate of 5. So mathematically, cost of redeemable preference share will then be equal to 80,320 plus 125,720 equal. That's 206 to 206 and 40,000. 206 and 40. Okay. I would then say 80,320 divided by 206,040 equal, multiply by the difference between 10 and 5, which is 5. Multiply by 5 equal plus 5 equal, that's 6.95%. Here is 6.95%. Approximately, KP is approximately 7%. The cost of redeemable preference share is approximately 7%. This is how to calculate cost of redeemable preference share. Let me know if you have any question for me. Okay? Any question for me? So in the absence of no question, I will stop sharing this, then move to cost of debt. We have done so far so good. We have treated cost of how to calculate cost of equity, and we just finished how to calculate cost of preference share. We did cost of redeemable preference share. We also did cost of irredeemable preference share. So let's go to cost of debt. I'll stop sharing this. Now, the cost of debt is simply the compensation required by the providers of debt capital. The cost of the cost of debt represent the, like I said, the compensation required by the providers of debt capital in form of interest expense. The debt holders will usually be settled before the ordinary shareholders and then the preference shareholders. In the event of liquidation, when a company liquidates, the first category of investor that will be settled is the debt holders, followed by preference shareholders. Then any residue will be taken over by the ordinary shareholders. Now, when it comes to cost of debt, the cost of debt debt in general is a cheaper source of financing. Why? Because of tax deductibility benefits. There is a tax relief, there's a tax benefit attached to financing with debt capital. So instead of say, for example, if the interest rate is 10% and there's a tax rate of 30%, instead of the company to pay 10%, the company will only pay 7%. That means it's cheaper. And that is why debt is a cheaper source of financing, because of tax benefits, tax deductibility benefits. Again, just like you have preference shares, we have redeemable debt. We also have irredeemable debt. Now, when it comes to redeemable or irredeemable debt, you can also say we also have callable debts and then non-callable debts. Callable or non-callable debts. Just like you say redeemable or irredeemable, but they are slightly different. They are slightly different. When you say callable debt, a callable debt is the one in which the investor, can make a recall on the investments before the maturity date, depending on the market, on the value of the investments. If the interest rates is likely to change in favor of the investor in the future, then the investor may call the investment, may make a recall on the investments. Okay, but the non-callable is the one that will show that the investor cannot make a recall on the investments. Okay. Anyway, that's not where we are. There are other things to be discussed under callable or non-callable, but it's not within the syllabus. Let's move on to where we have discussions. So let's talk about irredeemable and then redeemable debt. When it comes to let's start with irredeemable. For irredeemable debt, the irredeemable debt is the one in which the company will pay annual fixed interest to perpetuity, but the principal will not be repaid. Okay, I repeat, the irredeemable debt is the one in which the company will pay annual fixed interest, but the principal will never be repaid. Every year, the annual fixed interest will be paid, but the capital contribution, the capital investments, the principal sum will never be repaid. Okay. Then how do you calculate cost of irredeemable debt? The cost of irredeemable debt is computed as the ratio of fixed interest to X int price, depending on whether there is tax or no tax. Okay, let me show you. Now, where there is no tax, cost of irredeemable debt is the ratio of fixed interest to X int price. That is the formula you need to use. Just like you have SDIV share price, you also have X int price. The X int price is the market value of the debts. Okay, there are different forms of debts. I will tell you as we progress. Okay, so yes, the same principle applies there. The same principle you have other cost of equity. Now, if the interest expense has not been paid, then it means that the price of the debt is cum int price, is cum int, and you cannot use cum int to compute cost of debt. It has to be X int price. So adjustment will need to be made. Now, that is where there is no tax. Where there is tax, then you need to incorporate that. So where there is tax, the cost of debt will then be calculated as fixed interest multiplied by one minus tax rates. Okay, divided by X int price. Multiplied by 100 over 1. Now, one thing you need to know as per debt is that debt is always quoted at 100 naira per unit. Okay, debt is always quoted at 100 naira per unit, except examiner says otherwise. At times, examiner may say the bond is quoted at 1,000 naira per unit. But other than that, where examiner is silent, it is assumed that debt is quoted at 100 naira per unit. Please take note of that. So that is as per irredeemable debts. Let's have illustration to demonstrate that irredeemable debts quickly. Okay. Let's solve this illustration number 4. I need somebody to read for us, please. Somebody should read. Who is helping us quickly?
Albadin PLC.
Thank you.
With 10 million naira, 9% redeemable venture quoted at 102 naira. Interest on the venture was paid last week. What is the cost of the venture if the company is not liable to pay tax? Secondly, what is the cost of the venture if company tax rate is 40%?
Yes, thank you very much, Wellington. So let me stop sharing this and move to the working notes because of space. Okay, the name of the company is Aberdeen PLC. Illustration 4. Aberdeen PLC. Requirement number I. We are to calculate cost of the venture if the company is not liable to pay tax. So I would then say calculating costs of the venture. KD. Number 1, if the company is not liable to pay tax. Okay, so if there is no tax, then cost of debt will be equal to fixed interest divided by X int price. Multiply by 100 over 1. So KD will then be equal to, I will need to go back to the question. What is my fixed interest? According to the question, we are told that Aberdeen PLC is financed with 10 million naira, 9% redeemable debenture quoted at 102 naira. That 9% redeemable debenture, that 9% is the coupon rate. Coupon rate is the same thing as interest rates. That is the fixed interest. So that 9% is the interest rate we are looking for. So I will then come here, I will say 9. I don't need to say 9%, just put 9 because debt is always quoted at 100 naira per unit. So there's no need for you to say 0.09 or say 9 divided by 100. Just ignore the percentage, put 9 there because debt is quoted at, already quoted at 100 naira per unit. So X int price. I will then go back to the question. What's the market value of the debenture? We are told that redeemable debenture quoted at 102 naira. Interest on the debenture was paid last week. So that 102 naira excluded interest because we are told that the debenture interest was paid last week. So in that case, we are going to use the 102 like that. When you look at this question, the examiner mentioned redeemable, 9% redeemable debenture. Ordinarily, an average student may get confused in this particular question because examiner has mentioned redeemable debenture, but it is not redeemable debenture because we are not given the redemption date in the question. As I've told you, the difference between redeemable debenture and irredeemable debenture is the redemption date. So if redemption date is not given to you, it is irredeemable. But if redemption date is given in the question, it is redeemable. So please know the difference between the two. All right then, so 102 is the market price. Here is 102 multiplied by 100 over 1 equal. What do you get here? 9 divided by 102 equal, multiplied by 100 equal. That's 8.82%. 8.82%. Therefore, cost of irredeemable debenture is approximately 9%. That's it. So I used the wrong space. I used the wrong space. Please know the difference. So we are going to move. We are going to continue from the next page. I never knew that I already have working down there. So continue on the next page. Continue from the next page. Yeah. So let's continue from here. The second part of the question is where there is tax of 40%. Okay. The first one that we just solved, if the company is not liable to pay tax. So number 2 now, high. The company tax rate is 40%. If company tax rate is 40%. So if that is the case, then cost of irredeemable debenture will then be equal to fixed interest multiplied by 1 minus tax rates divided by X int price. Multiplied by 100 over 1. So KD will be equal to The interest rate is 9%. Tax rate is 40%. 1 minus 40% will give us 0.6. Let me just put 0.04 divided by X int price is 102 naira. Multiply by 100 over 1. So KD will then be equal to 9 into 0.60 divided by 102. Multiply by 100 over 1. Final answer. Bring out your calculator. 9 multiplied by 0.6 equal, that's 5.4 divided by 102 equal, then multiply by 100 equal, that's 5.29. Here is 5.29%. So cost of irredeemable debenture is approximately 5%. You can see that when there is no tax, the cost of irredeemable debenture is 9%. Now that we have tax rate of 40%, the cost of irredeemable debt has reduced to 5%. That is why we said that debt is a cheaper source of financing because of tax deductibility benefit, because of tax benefits. So debt is a cheaper source of finance. So that is as per that question. So what we just did is to treat cost of irredeemable debts. Let's talk about cost of redeemable debts. Okay, it's already 11 o'clock. Don't let me, this is the first lecture days, so don't let me stretch you for too long. All right, so this is where we are going to call it a day. Let me know if you have a question for me. And yeah, any questions so far? We cannot proceed because we have about 2 minutes more to end the class. If I delve into cost of redeemable debts, it will take us another 15 to 20 minutes. So we postpone in our next class. Any questions so far? Okay. I just need to tell you that time and time wait for nobody. Poco a poco. Before you know it, we are getting to the D-Day. Even though today is the first lecture day, we have about roughly 4 months during the course of this class, okay, for us to be able to do justice to the syllabus. 4 months. It will look as if that April is very far, but it's right at hand. Yearly preparation is key to your success. Therefore, I will encourage you, now that you have decided to write ICAN May 2025 diet exam, I will encourage you to take it very seriously, because as you lay your bed, so also you will lie on it. Yearly preparation is key to your passing ICAN exam, especially strategic financial management. Please, guys, I will advise you, get all relevant materials and be studying on your own before you have any class, because it's going to help you in a great way. It's going to help you a lot by reading ahead of the class. Currently, we're having cost of capital. A wise student will go ahead with your material, go and read in details what cost of capital is all about. If you have any challenge, you itemize it so that when you come to the class, you'll be able to ask pertinent questions from your lecturers. It is important. You have to be proactive. You have to read ahead of the class, because we can only pray that God will make it easy for you. No matter how easy is a question, if you don't know, you don't know. There's nothing you can do about it. No matter how simple is that question, provided you don't know it, then there's nothing you can do about it. Please, I beg of you, take it very seriously. Time is taken out. Just like yesterday, we started January 2025. Today is January 8th. You can see how fast it is. Hey, so before you know it, April will be here. I pray that God Almighty will grant you a retentive memory. Whatever that you are being taught in the class, God will make you to remember it, and God will grant you beneficial knowledge, so that at the end of the day, when your result is being released, you have every cause to say, God, I thank you. All my efforts did not go in vain. So may God make it very easy for you. So good night, everyone. I will see you next week by the grace of God. Bye-bye.
Thank you very much, sir.
You are welcome.
Thank you very much, sir.
You are welcome, Esang.
Thank you, sir.
Yes. Good night.